And we'll now be proceeding to the last panel session of the conference, the much anticipated precious metals price outlook. To moderate the session, we have Mr. Philip Klapwijk, Precious Metals Insights, and inviting the panelists on stage. Joining us, we have Mr. Nikos Kavalis, Director, Metals Focus. Thank you very much for the applause. Next, we have Ms. Joni Teves, Chief Precious Metals Strategist, UBS Investment Bank. And last but not least, we have Mr. Yuichi Bruce Ikemizu, Head of Tokyo Branch, ICBC Standard. Once again, ladies and gentlemen, feel free to use Slido for your questions, and I'll be handing over the 1 hour and 20 minutes over to Mr. Philip Klapwijk. Thank you very much.
Okay, good day for the Aussies amongst us. This is the precious metals market review and price outlook session, which will run for about 1 hour and 25 minutes. I'd like to thank the Singapore Bullion Market Association for inviting me to moderate this session. We are going to review all 4 major precious metals: gold, silver, platinum, and palladium. And we've got 3 speakers here who are going to help us do that. Each of them will give a presentation, and then we will have a Q&A session. The presentations will be made on gold by Joni Teves. Joni is a precious metals analyst and global macro strategist on the global macro strategy team at UBS Investment Bank in London. She's worked there since 2011. And prior to this, she was working for several years as a gold trader at the Central Bank of the Philippines. So real world experience there in the nitty-gritty of gold dealing. We then move to silver, where Nikos Kavalis will make a presentation on that metal. Nikos has over 17 years experience as a metals analyst and strategist, initially at GFMS, where we worked together, then at Royal Bank of Scotland, and in recent years at the leading precious metals consultancy, Metals Focus, where Nikos is one of the company's 3 principals. We then finally move on to the PGMs, specifically platinum and palladium, where Bruce Ikemizu will provide a presentation on these 2 metals. Bruce has worked for over 30 years in the precious metals markets with Sumitomo, Credit Suisse, Mitsui, and Standard Bank, which since 2015, of course, has been ICBC Standard Bank, where he is the Tokyo branch manager. Without further ado, let's turn over the podium to Joni, who will make the presentation on gold.
Thanks, Philip. And good day to everyone. I hope you can see me behind this very tall podium. I'm afraid I forgot to wear my tallest high heels today. It's a pleasure for me to be here, and for those of you who were here last year, you can understand that I am particularly delighted that I'm not doing the wrap-up today and just doing the presentation on gold. This means that I could have enough time to prepare my presentation, but perhaps I did prepare it a little bit too early and therefore not quite capturing the latest move in gold. I blame Philip for that because he asked me to send through my presentation on the 31st of May. A bit too early. So, as you can see in my first slide, it shows that it's at least 2 weeks old. So since then, indifference towards gold has been starting to fade, particularly given gold's recent performance and the escalation, or at least the escalation in trade tensions between the US, China, Mexico, and even that dynamic has been moving quite quickly. So over the last week or so, gold has been reasserting its role as a safe haven. ETFs are back to positive year to date, up 6.69 million ounces, and month to date is actually up 1.34 million ounces. Now, the challenge with gold and safe haven flows is that it does tend to be quite vulnerable to headline risk and therefore vulnerable to a reversal. And I think we saw some of that in the recent headlines with Mexico, where gold was trying to push higher, but then there was a bit of a resolution in recent days, and therefore you get a little bit of a pullback. More generally, gold's reaction to these types of headlines, I mean, we've seen it all through 2018, where the impact on gold was a bit more muddled. So the risk aversion, low rates, and weakness in equities tends to be offset by a stronger dollar, which also tends to be a safe haven when there's a lot of risk aversion in the market. And indeed, the dollar is an important driver for gold, and last year it was an important headwind. And we think that this continues to be a dominant factor. This is just a chart of our gold model where we look at different factors that affect the price. And it's quite simple. It uses copper as a sort of a proxy for broader commodities. Obviously, we take into account the dollar. In this one, we use the dollar index. Spreads here, we look at European sovereign spreads, as we did want to capture the impact of the sovereign crisis several years ago on gold prices. And the other key factor that we use here is real rates, which we use the 5-year tips as a proxy. And as you can see on the chart, the dollar continues to be a dominant driver for gold prices. And it is actually the reason why gold didn't really move much until recently. So one of the most common frustrations that I've been getting over the past couple of months is that, why is gold not moving even though, trade tensions have been ongoing, rates have been under pressure, the equity markets have been under pressure. But if you actually look at the reaction of the dollar during that period, the dollar was actually hovering near the highs. So I think that was a clear headwind for gold as well. And in fact, I think this is also the reason why in gold's recent performance, it managed to go back above 1,300. Because the escalation in trade tensions when we first got those headlines about Mexico tariffs was also around the same time that the Fed started sounding dovish. So on the same day, you actually had comments from Clarida that were more on the dovish side, and that's when expectations on the Fed cutting rates started to really pick up, and therefore the dollar was way down during that period. I think this is what allowed gold to get back above 1,300. What was interesting in this recent move in gold is that it did pick up a lot of investor interest, but a common theme perhaps in my conversations with various market participants since that move is that people are a little bit skeptical here. People ask, what's different this time? We've seen this safe haven move before. We've tried 1350, 1375 over the last several years, but we haven't really managed to break above it. Those who are probably a little bit more convinced about gold's move here tend to be those who look at gold as a diversifier for their portfolio, particularly those who are expecting the Fed to cut rates, perhaps because of further escalation in trade wars that will lead to deterioration in the data from here. Certainly, I think growth risks do provide support for gold, especially as trade tensions linger. And I think this is why, despite some resolution in the situation between the US and Mexico, gold has actually managed to keep most of its gains so far. In the near term, what does worry me a little bit about gold is the extent of Fed pricing. So there's a lot of Fed cuts already priced in the market at the moment, and I think this makes the gold market a little bit vulnerable to potential disappointment. For instance, our US economists have reiterated their view that they don't think the Fed can cut rates anytime soon. Obviously, that is the risk is skewed to that side, but the data so far does not justify the Fed to cut. It hasn't weakened enough. It has to weaken further before the Fed can move. And given where markets' expectations are, it won't take much for the outcome to be a little bit more hawkish than where market is expecting. And this could rein in gold's upside for now. This is particularly amplified by the fact that in the near term, positioning in gold has actually picked up quite a bit. The latest CFTC data actually shows, so this is obviously late, but the latest data, which is as of last week, shows that gold net longs on COMEX increased by over 8 million ounces. Quite a chunky number. A lot of that was actually due to fresh longs, a bit of short covering as well, but I think over 5 million ounces of that was actually fresh longs. So again, it adds to the sort of potential headwind for gold up ahead if we do get some disappointment with the Fed. However, more broadly, I think one thing that has been a supportive factor for gold over the last few years is, broadly speaking, positioning is light. So not a lot of people are long gold, and this actually, I think, over the longer term is a supportive factor for gold, allowing room for investor exposure to rebuild and grow over time, especially as we are nearing the end of this cycle. Moving to the more fundamental part of the market, physical demand, I think, should be relatively average this year, so a bit of offset in different regions. China has been a little bit soft so far, which is understandable, given that core demand should be under pressure from all the economic uncertainty and sort of people being a little bit more conservative about jewelry purchases. But this softness in China is somewhat offset by strong Indian demand. So net, looking at the World Gold Council data, for instance, for Q1 demand, the world as a whole is broadly flat, maybe slightly up year on year. Ultimately, physical demand doesn't really move prices. From our perspective, it's really macro factors that tend to drive the price of gold, and therefore this flows through investment sentiment. But physical demand is important. I think it is important to provide support to the market. And I think even though physical demand is probably going to be in line with historical averages this year, I think that should be sufficient to provide the market with needed fundamental support. Another source of support, but not likely to have a visible impact on prices, is central bank buying. Based on the pace of purchases so far up until early April data, it looks like the sector as a whole is probably on track to buy about 500 to 600 tons of gold if they keep the same pace of buying throughout the rest of the year. My sense is that we are unlikely to see more than 650 tons of buying, which is what they bought last year. But it is encouraging to see that the list of buyers from this sector has become more diversified. So there's been a lot of new names that started becoming active in the gold space again from last year. That trend seems to have continued for this year, and a clear sort of motivation for this renewed interest from the official sector is wanting to diversify dollar exposure, or wanting to diversify away from their dollar exposure. So I think that theme is probably going to continue this year and should keep this part of the market supportive overall. On the supply side, there's not a lot to say. There is probably more interesting things going on in the equity side with the mergers and acquisitions, but despite all of this activity, it is unlikely to have much impact on global supply of gold. And therefore, I'm not expecting this part of the market to actually have much impact on prices either. Finally, going to our outlook, we have held a broadly range-bound view on gold for some time, but with upside bias. We expect prices to average around 1325 this year, so that basically takes into account that we will test the top side of this range at some point this year. I think that's probably going to happen, or the risk of that happening is more skewed around the third quarter, where you tend to have relatively strong physical demand. Also, that's when market is expecting Fed to cut potentially September, which could be a big catalyst for upside in gold. And more generally, over the next few years, I do expect prices to gently drift higher, maybe about 2% gain per year, as strategic investment, which I said tends to be kind of low at this point, start to grow. I think the risks are very much skewed to the upside for gold here, and the potential for growth to deteriorate, I think, would be an upside catalyst, particularly given higher tariffs and the impact of that on growth, both in the US and globally, and just the impact of ongoing trade tensions. The potential for the Fed to cut is also a big upside catalyst for gold, in my view. And really, what I think the two main factors that could move us from my base case to our upside scenario would be if we see a marked shift in Fed policy into easing, and for the dollar to decline more sustainably. This would mean that real rates would decline sustainably as well, and maybe perhaps go back into negative territory. And I think this would then be a more sustainable driver for gold upside rather than sort of safe haven flows alone. I leave it there to allow for more time for my colleagues to also give their views on the other metals, and for more time to discuss later on. Thank you.
Thank you very much, Joni. We'll now move on to the restless metal, silver. Nikos will give us his views on that.
Of course, before anything else, thanks a lot to the organizers for doing such a great job again, and bringing such a high quality attendance together this year. And of course for inviting me, and particularly Albert, thanks a lot for allowing me to share my views with everyone today. For those of you who don't know me, I'm Nikos Kavalis. I'm one of the founding partners and directors of Metals Focus, and today I will talk to you about silver a little bit. And I know most of you see silver as very much a high beta trade on gold, and you're very right to do so. But I do think that it's useful and interesting to every now and again look at the market's fundamentals and see where we are from a supply-demand perspective. And on the occasion of the launch of our annual Silver Focus Report, the yearbook that looks at the market and current state of the market and the near-term forecast, I thought it's a good idea to run through some of these themes. First of all, taking the 30,000-foot view, silver was once again in a supply surplus in 2018, according to our estimates, and we expect this will continue to be the case next year. Now, comparing the picture of the market, the current picture of the market to 2017, 2018, we can see a noticeable improvement. And this noticeable improvement has come as a result of a number of factors. But we would say that in spite of such an improvement, we are still seeing a market which is in a structural surplus, and something which is very much reflected in the above ground inventories that we can identify in the market. And if we just purely look at what's, let's say, reportable, combining the local London stockpiles with the COMEX stockpiles and those that we can see in the Shanghai exchanges, just these identifiable areas of the market had nearly 50,000 tons of silver at the end of last year. And we think that this picture is very likely to continue for the foreseeable future. Driving the main factor driving the improvement in the overall supply-demand picture of silver was the decline that we saw for mine production. Last year we experienced a 3% decline in total supply, and behind that lies primarily a decline in primary silver mine production, reflecting declines in grades, but also some falls in copper byproduct production. Of course, another factor that kept mine supply under pressure was the fact that the huge Escobal mine continues to be shut as a result of disputes with local groups. Looking into this year, a reversal in the trend of grades is the main reason behind the quite significant 4% increase that we forecast. And I should say that there are some wildcards on the horizon. First of all, there's still a lot of uncertainty as to when and if the Escobal mine will start again. And there are also some uncertainties in some of the Mexican operations. But allowing some probability adjustments to all these, we expect a pretty healthy increase. The other main driver of the improvement in the surplus, and something which we believe will continue to be a theme this year, is a recovery in global investment demand for bars and coins. And if we look at the numbers in some detail, last year we can see that what has now become the world's biggest market for bars and coins, namely India, made the largest contribution to this increase, whereas this year the baton shifts a bit to the United States. However, I think the important point to put across is that even after these 2 years of pretty healthy gains in the two biggest investment markets, demand overall is a fraction of what it used to be back in the glory years of 2013 and 2015. And we believe that, we are adamant that this is a very big problem for the physical silver market, and very much one of the key reasons why we are in such a structural fundamental surplus overall. Driving this, let's say, lackluster interest on silver bars and coins are a number of very different factors. I think it's interesting to look at the two biggest markets. In India, we still have, it's the major structural change compared to a few years ago of the very aggressive clampdown on informal incomes or unreported incomes, much of which was naturally saved in silver bars. And this is something that's almost irreversible. You also have issues of market saturation, and actually these apply to both markets, both the Indian and the US market. In the US, it's a very different story. There we have a market, there we have an investor community which is very much enamored by the strength of equities, relatively benign until very recently outlook for the US economy. And frankly, even after the challenges that we've seen more recently, we believe that the typical silver physical investor is not quite convinced yet that there is as big a crisis as perhaps the smart money is looking for. Staying with India, another area that India has been instrumental to is the growth of jewelry and silverware. And whereas in investment we expect some contribution from the US in 2019, when it comes to jewelry and silverware, this is almost exclusively an India story. And there we see genuine structural growth stemming from growth in local incomes, but also the impact of lower silver prices. I mean, that has had a very dramatic impact in the sense that a given budget that's spent by a typical consumer buys a lot more silver than it did a couple of years ago. One quite disappointing area of demand has been industrial offtake, and in particular electronic and electrical. And we should put some things in perspective here. We have to acknowledge the fact that in spite of a small decline last year, or effectively a flat profile last year, demand maintained near all-time high records. However, this was still a disappointing result because over the past few years there was also an assumption, or a received wisdom if you want, that industrial demand will continue to grow as a result of areas such as automotive demand, as a result of areas such as photovoltaic demand. And last year we saw this trend effectively be arrested. A big contributing factor to this was the change in policy in China, making it a lot more difficult or a lot more challenging to continue with strong growth in photovoltaic or solar installations. Another factor has been the trade war and the impact that the trade war has had on supply chains across the board in particularly electronic products or components, and specifically most of the supply chain being very wary of maintaining high inventory levels. And that had quite a profound impact on demand, particularly from September onwards last year, and is certainly capping consumption this year to date. We have, unlike many in the market, we have a cautiously optimistic view that, at least in part, trade disputes will be resolved at some point later in the year, and we hope that this will result in some recovery in consumption. Final point I should point out, in spite of the slowdown in car production that we're seeing in most key markets, our understanding is that silver demand, specifically in automotive applications, continues to grow, and this is mainly as a result of ongoing electrification and ongoing, let's say, evolution of various electronic systems that are installed in cars. The weakness, or let's say the slowdown in industrial consumption growth has secondary impacts on the silver market that go over and above the fundamental supply-demand picture. And this is because silver is perceived by many investors as being a quasi-industrial product. Of course, everyone sees silver as far more correlated with gold than, let's say, base metals, but there is a perception among investors that silver is an industrial product, and this is very much a correct perception because, as you can see from this chart, more than half of silver's consumption on an annual basis goes into industrial applications. And we think that at least in small part, this had been a reason why, even though in recent weeks gold has benefited quite a lot from, let's say, heightened tensions or concerns about the outlook of the global economy, silver is still being forgotten. Of course, part of the reason behind this is that silver, unlike gold, is not seen as an ultimate store of value, and it's not, seen as the ultimate reserve currency. And you can see this in the fact that central banks don't particularly hold that much silver. But I think an important contributor to this picture, to the fact that silver is still in a net short when it comes to speculative positions, when gold, if memory serves, has a net long of around 300 tons or so. I think the perception that in a weak industrial cycle or a weakening industrial cycle, silver might not benefit so much is certainly plays a part. I will finally conclude with our price forecast. So in spite of all these headwinds, we maintain a cautiously optimistic outlook for silver. And this is very much reliant on our expectation for gold. And in turn, our constructive expectation or constructive outlook for gold is based on our outlook for the dollar to weaken later in the year. Predominantly, this reflects growing expectations that the Fed will reverse its tightening cycle, which it has already stopped. Signs that Jay Powell is very much influenced by pressure from the markets, as well as pressure from the US administration, which is very much calling for a far more dovish stance. And we think that all this will weigh on the US dollar. And when you combine that with challenges in the global economy, I think this should see both gold and silver prices grow later in the year. Indeed, we believe that if it wasn't for the strength of the US dollar, which is in very large part a reflection of the flows into the currency because of the trade war concerns, we believe that gold and silver prices would be significantly higher than they are today. Final point that I would like to touch on is the relative valuation between gold and silver. As many of you will know, we very recently got to a gold-silver ratio that we hadn't seen since 1993, above the 90 mark. And we do think that as both metals move into, let's say, more bull market territory, silver is likely to regain its high beta property to gold and gain some of the lost ground. However, unfortunately for the silver bulls, we do not think that silver will manage to regain all the ground that it's lost. Indeed, even at our peak towards the end of the year, we still see the gold-silver ratio in the upper 70s and almost 80/1. And with this, I would like to thank you for your attention. If you would like to hear more about what we do, please get in touch with us. And for our friends in China or our friends that can read Chinese, please use the QR code to subscribe to our WeChat channel, where you can get a lot of our free reports. Thank you very much.
Thank you very much, Nikos. We now turn finally to platinum and palladium, and Bruce will give us a review of those markets.
Good day, everyone. And first of all, congratulations for 25th anniversary for the SPMA. And Albert, especially, thank you very much for inviting me to speak here in consecutive 3 years. I talked about PGMs last year, and I'm going to talk about PGM this year as well. And in this whole conference, this is only spot which speaks about PGMs. This is totally gold conference. I really feel it. I sit down from day first and listening to all the speeches and everything, and it's all about gold and no PGMs. And so I feel kind of very minority to speak about platinum and palladium. But so this is, well, I should say it's quite important session. But as everyone knows the market, let's look at the move from the last year. This time, I put up the 1-year chart from Bloomberg. Last year, when I speak about platinum, it was about like $1,000, I think. Right? No, I'm sorry, $900. So as a result, this morning is about around 807. So platinum lost about $100. We had a high of 915 in March, but it couldn't hold above 900 level and come down quite sharply to 800. Let's look at the palladium now. Palladium, I actually didn't clearly remember what I told about platinum last year. I'm sorry. But Palladium, I was, well, I actually don't remember, but somebody I met yesterday was told me what I told. And the Palladium at last year was 1,000 ounces around. And now we are around, this is a little bit old, but 1385 around this morning. So Palladium went up, at one time 16 to 1600. And quite nice rise we had seen this year. And I've been very bullish on Palladium, and that somebody told me that, oh, you are pretty sharp. And he didn't mention about platinum, so maybe I was bullish on platinum as well. But this one-year chart shows quite nice contrast between the two metals. So when I speak about platinum and palladium, the content is totally different. Uh-oh. Looks like this is old chart. Oops. How can I go back to the first one? Okay, I'm sorry. Okay, let's look at the the surroundings of platinum. Thanks to Nikos, I used the data from Metals Focus. The fundamentals surrounding platinum is really bearish. And I have to say this again this year. I mean, according to Metals Focus, platinum surplus in 2018 was 10.8 tons, and this year, 2019, it is expected to increase to even 19.6 tons. And above ground stocks will add to add to 302 tons from the 215 tons a decade ago. Automobile catalyst demand lose 2%. Jewelry demand, especially China, decreases 3%. And physical investment eases by 15% even. And my output forecasted to rise 3%. So this is all very bearish factors surrounding platinum. And these days, especially recently, last week, South African rand hit like 15 rand per dollar, which is very, very cheap, and which makes rand-denominated platinum price sharply higher. And I think South African producers, which consists of about 70 to 80% of the whole global mining production, would be happy to sell platinum. So it's all the things is really points that platinum doesn't really have bright features, at least near term. So I don't say I'm bearish, but I'm not really bullish at all about platinum. I kind of expect platinum will stay around this area, probably 770 to probably highs of 900, 920 level. It all depends, I think. The only hope that we have for platinum is the gold price. If gold hit above 1,400, probably platinum would go up to 900. But if it could hold that level, it really depends on performance of the gold price. So I'm not really bullish on the platinum. But again, if you think about the downside below 800, I basically think platinum now here is too cheap. But so the value of the metal, I do believe, is much higher than gold. So I think about production cost and everything. The platinum's value should be hold the price below like $800. So personally, I mean, as an investor, I'm buying platinum physicals when the market dips. I buy gold as well, but since the price reversed, I'm buying only platinum. And my platinum stock is getting bigger and bigger, unfortunately. But hopefully, like 10 or 15 years' time, my investment would be great. But then, let's see. Palladium now, if we look at the palladium fundamentals, the very good contrast to platinum, this is deficit market. Like 2018, it was like 25 tons shortage, and 2019, the slightly better, but still 70.9 tons shortage is forecasted. As you can see, the chart they beside it, palladium deficit is like 8 years in a row. So, and it is expected to be so in near foreseeable future. So if you think about this very, very fundamental, I think the palladium still have some more room to go up, not go down. Of course, we had seen 1600 this year in March, and it might be a little bit too heated by the investors, activity. But after those investors sold and took profit, and we are around 1300, and we are slowly going back to at the moment is 1385, and volatility is volatility is quite high, and the liquidity is not too much. So, $50 or $100 even move in a day is not really. I would say like popular in this metal. So I will be very cautious, but again, I am, as last year, I'm bullish on the palladium from here. And I would expect the palladium trading range this year will be 1275 as a low, and probably we would see 1500 again later this year, or probably earlier, if you think about these fundamentals. Yeah. Okay. I already said about price outlook so far, but one thing that I want to add is about the substitution of palladium by platinum. Lots of people talking about this move might occur quite soon, but I had chance to talk to some of the catalyst makers in Japan recently, and most of them, I would say all of them says substitution is not that easy work. It takes time and it costs a lot. So because the especially automobile catalyst production line is made for palladium, it's not, if you cannot put platinum instead of palladium into that line. You have to start with from scratch, zero. So it takes like a year or so to start the making platinum catalyst for palladium. Then it is a decision has to be made, I mean, by the car makers that if they want to switch the catalyst, I mean, gasoline engine catalyst to platinum catalyst. Well, it is nobody would be really 100% sure that palladium platinum price relationship would continue as it is like next 5 years, 10 years time. And also another thing which I really kind of impressed is that car makers told me that the price of the catalyst is very, very small portion of, if you think about the whole cars. And the usage of the metal, like palladium or platinum, is like a couple of grams only. So for one car, it's like 2-3 grams, the usage of palladium or platinum. And the difference, price difference between those two for 1 gram, 2 grams, 3 grams is really negligible. They don't want to make big changes because of that small kind of cost. So I don't really expect this substitution, especially for the automobile catalyst, would soon happen enough. So that would support that palladium, bullish factors for palladium and bearish factors for platinum still to continue at least 2-3 years or 5 years, I think. And then you think about the electric vehicle and FCVs, fuel cell. Fuel cell, of course, uses more platinum, and platinum mining house is really kind of supporting fuel cells. But at the moment, I mean, EV is, of course, is popular, especially in China and even in Japan now. But still, I mean, even FCV or EV getting more, circulated, more popular than now, but I don't really think that would be such a big changes to the market. I mean, car manufacturers' market, because up until now, the gasoline cars are really the majority. And if we want, I mean, if you think that PGM catalyst will not be needed so much once those cars are replaced by EV and FCVs, but that would happen until, I think, like 10, 20 years easily. So I really think this PGM, I mean, especially palladium, bullish market, and platinum is not bearish, but the staying very low tune would continue. I mean, at least like 2-3 years. So let's see. I mean, next year, if I have the chance to speak here about PGM again, I will remember clearly what I spoke today, and I will compare the market in 1 year time. Thank you very much.
Thank you very much, Bruce. We will not give you any respite, though, because I'm going to start asking you a question straight off about platinum. I mean, you've described a situation which basically platinum supply and demand at the moment sucks. We're expecting a near doubling of the surplus projected on MF's numbers. Autocats down, jewellery's down. Supply, meanwhile, is holding up quite well, in part because the basket price in South Africa is actually pretty good if you take into account palladium and rhodium prices and the exchange rate to the US dollar. What could actually change this for the better? Can we expect a miracle in China and better platinum demand in the future for jewellery? Might fuel cells come in a bit earlier than you think? Or maybe, what about South African mine production? I mean, let's look at gold. Gold mine production in South Africa has gone from 1,000 to less than 300 tons over a generation. Is it really sustainable in South Africa mine production at these levels, given the sort of, particularly the economic and social environment in that country?
Well, I'm not really the specialist about those supply side production-wise. I mean, I really want to hand it to Nikos, but I think there's, from my point of view, there's really no magic is in store for the platinum. I mean, I don't really think the China will buy platinum jewelry like 2 times or 3 times more. I mean, this year, or diesel cars would be again, gaining popularity in Europe or even in Japan. I mean, people are really have a very bad negative feeling about diesel. Although I personally think diesel engine is quite good. There's a quite good diesel engine. But so I think if there's any miracle for the platinum to go up, it's really the gold price. And South Africa, well, looks like currently the government is doing just opposite. I mean, for the producers to make more platinum to get the cash in. That's what I feel.
Thanks very much, Bruce. What about Palladium? And maybe we also open this up to the other 2 guys on the panel. Palladium, in contrast, has got some excellent fundamentals. We can see tighter emission controls down the track, increasing demand for palladium. As we heard from Bruce, substitution, I think, and I completely agree, is not going to be an issue in the next few years. But what about the supply side for palladium? I know MF have produced some interesting numbers, Metals Focus have produced some interesting numbers looking out to 2023, where we see prospect of much higher supply coming on stream. I mean, do you think, Bruce, and maybe then Nikos could also chip in, there is much prospect for, at least if we take a 5-year view, that higher production, mine production, and also a lot more autocat recycling could sort of improve the situation and reduce that deficit substantially if we take, say, a 5-year view?
Well, as long as I know, the palladium basically a byproduct of nickel and the platinum, right? So as far as I know, there's no palladium mine, which means you cannot really easily control the palladium production. Of course, palladium much higher than platinum now, and they want to produce palladium more than platinum, I think. But if they could control it, they would have done that already, I think. So it's not that easy to produce more palladium than currently both Russia and South Africa is doing. But that's probably we should hear from Nikos.
Excellent way to avoid the question, Bruce. Wonderful. So look, yes, for sure, obviously our numbers are showing quite significant gains in mine production and recycling. And while I fully agree with Bruce that there is palladium is typically a byproduct metal, what we are seeing is more and more investment decisions being skewed at operations that, in theory, you would call platinum, primary platinum mines, but with far higher palladium grades than you would typically see, for example, in South Africa. As if you look at the next few years, where production is shifting is very much towards the operations that are closer to 1-to-1 ratio between palladium and platinum. Then you also have a ramp up in production in North America. And our numbers only go to 2023, but I think where it gets even more interesting is beyond that, when you have South Cluster kicking off in Russia, and even further into the future, potentially the JV between Norilsk Nickel and Russia Platinum, although this is still really very much early days, but I think you make a very interesting point that even though palladium looks by far as the best, well, perhaps second to rhodium, by far the best or the second best fundamentally precious metal, if we look towards the end of the next decade, that might very well be very well not be the case anymore.
Yeah, I mean, I would agree. I mean, I think if we look through to the end of the 2020s, the other thing to bear in mind, apart from the increase in supply that Nikos has mentioned, is what's going to happen to that gasoline demand as we see increased electric vehicle production. So I think, you know, at some point there's going to be a tipping point for palladium autocatalyst demand, and by the end of the next decade, I think that will be heading south at speed. So that's something I think to bear in mind for the longer run. If we can continue with Nikos for a moment, and we'll come back to Jody big time when we start to look at gold, but I think we get the minor metals out of the way first. If we look at silver, and you know, bearing in mind what you told us about bar and coin demand, I mean, I was also thinking when you were making a presentation about industrial demand, and that it's close to 53-4% of the total. And I'm thinking, well, you know, what about the vulnerability of this to a global economic downturn? I mean, we've seen lately how silver has tended to follow perhaps more copper's lead as people get a bit pessimistic about the global economy. If we were to see a coordinated global downturn, you know, I'm looking at that close to, is it 16,000 tons of industrial demand for silver, and thinking, well, what happens if we lose a fifth of that? That's going to go a long way in offsetting any corresponding increase in investment demand that we may see. And then I think, well, you know, is the investment demand going to come through properly, given the sort of structural issues Nikos was mentioning about bar and coin investment? So I'd be interested in your view on that sort of dichotomy.
Sure. First of all, I think it would be hard to actually see a 20% loss in industrial demand, even under the most aggressively pessimistic scenarios. You see how you still have structural factors requiring more silver in certain applications, for most notably automotive applications, because there's more electronic components in a car naturally, and then you also have the additional boost from electrification. But you could absolutely have a few years of declines. I think the million-dollar question is what happens to gold during that time. I think if we see a big increase in professional investor interest in gold, I think there is no, in my mind, there is no doubt that silver's benefit will far outweigh the headwinds from the fundamental industrial side of things. And I think it's important to remember that silver never got to $50 an ounce because of strong industrial demand. It rather got there because every single fund on the street got excited about it and was looking at arguably questionable metrics of long-term, let's say, gold-silver ratios, etc. And then over and above that, you have the fact that the silver market is far, far smaller than gold. You know, a far smaller amount of money can move with a far bigger percentage than gold can be moved.
So, I mean, it's good you mentioned the ratio. We got to 32-1 in 2011, which is compares to about 90, I think it's 90.5 it was this morning. You think maybe the next couple of years we get to 70 and change, was it? What do you think that translates into in terms of headline silver prices over the next couple of years? Can you see 20 being exceeded by 2020, 2021?
Yeah, potentially. I mean, I know at this point it looks like a stretch, but you don't actually need that much weight of money to get silver from 15 to 20. Hey, it was 20, what, 2 and a bit years ago?
Yeah.
If memory serves. Wasn't it? It was. Okay, good. And look, within the short term, I think 20 is a very big ask. I think if our, let's say, next 12-month forecast doesn't even break above 18, or certainly for the rest of the year, we don't see it breaking above 18, and yeah, maybe towards the end of 2020, 2021, you could see something over 20.
So every dog has its day. Silver's going to be the best performing precious metal, perhaps, in the next couple of years, it seems. So let's turn to look at gold. And I'm thinking here that we've sort of heard about this rate cut issue, and that what if rate cuts fail to meet market expectations, which I think was a very interesting point Joni made. That this could be actually a pretty big headwind for gold over the next few months. The market perhaps has run away with itself in expectations of Fed dovishness. The other point here perhaps, and it's made by Bart Mellick this morning, was, well, what if they cut rates, but that just serves to, at least initially, push up the level of equities. How do you see that sort of playing out, Joni, given that equities have been such a headwind over the last couple of years? I mean, we've seen charts certainly showing that long run, the relationship between the S&P 500 and gold is basically zero, or very, very moderately negative. But certainly, I think anecdotally, we could see in the last couple of years, the interested stocks, and Joni mentioned this in her presentation, has really taken investors' interest away from alternatives like gold.
Yeah, I think if we do get a rate cut, and you're absolutely right, I think there's a feedback loop there where it also helps risk sentiment, it also helps equities, and therefore that could sort of take the shine a little bit off gold. But we have seen in the past that during when the Fed was in full easing mode, QE, and the equity market was in a long run, bull run, gold was also in a bull run during the same period. So I would expect the same sort of dynamic to occur where when the Fed moves into full easing mode, we can start to see gold rally even though the equities market is also rallying.
I guess one of the things that might stop a rally, I mean, what we've had so far, I guess, is people have bought the dip for stocks over the last few years. Stock market's gone down, but the sort of underlying economic fundamentals have not been really that bad at all, and so it's made sense to buy equities. What happens though if we do get a recession in the US, and that causes stocks to go down over the sort of medium term? Because let's bear in mind that this expansion now is on borrowed time, arguably. I mean, this is the longest expansion next month in US post-war economic history. Let's imagine that there is a recession in the United States in 2020, and maybe not this year, but next year the Fed really goes in hard, starts cutting rates. What happens then to the US dollar? What happens, in fact, to US public finances, given that we already have a deficit, government deficit of GDP ratio of 4%, and that's before we see tax revenue go down and government spending go up. I mean, is this going to sort of create the dynamic that we see a possibility of really significantly higher gold prices and a very positive circumstances for investment, and that this just leads to the price going higher and higher over a period?
Yeah, I think so. The two key factors that I see that can really drive gold prices higher and sustainably as well, so we move into that next strong bull run for gold, would be if growth in the US deteriorates, the Fed has to cut rates and the dollar comes lower. I guess the question here would be if if US growth starts to deteriorate, how does that impact the rest of the world? Because arguably, how the dollar responds is also kind of in terms of the US relative performance to the rest of the world. And although the Fed would be cutting rates, what are other central banks doing? Are they cutting faster? So I think that at that point, that would be the uncertainty. But in isolation, if we are saying that, okay, US rates are coming lower, the Fed is cutting, data is deteriorating, investors are becoming more concerned about the US finances, the dollar is moving lower, then all of these factors in themselves sound like a very bullish scenario for gold.
I mean, you touched there on the US dollar, which, I mean, if we look at gold at the end of the day, we can view it to a significant extent, not just as a commodity, but as a sort of currency pair. I mean, if we look at, say, the trade-weighted index at the moment of the US dollar, it's about 30% above its 2011 low. Another metric you could look at, I was looking at this morning, is that the US dollar, according to the OECD, is about 19% overvalued on a purchasing power parity basis against the euro. So, I mean, this suggests to me that, you know, if it cracks, theoretically, the US dollar has a long, long way to fall. But on the other hand, as we've been seeing, it does seem to attract safe haven flows when volatility goes up. You know, perhaps we can get a view from everybody on the panel, starting with Joni, as to, you know, are we going to see that happen, namely the US dollar sort of managing in a sense to hold its own, not drop too much, or will we see a sort of reversion to trend and a much greater drop in the US dollar over, say, a 2-3 year time frame?
That's a very good question. I guess the challenge with the dollar view right now is that, yes, it does attract safe haven flows during times of high risk aversion, but at the same time right now it does have a yield advantage to the rest of the world. And that's what's made it hard to be short the dollar and put your money in gold, because you are paying a lot of opportunity cost by holding a negative yielding asset like gold. But yes, against all metrics, the dollar does look overvalued. Positioning is quite crowded in the dollar, so there is room for that to adjust. But again, going back to my point earlier, I think it will depend on how the US economy performs to the rest of the world, and therefore how central banks' policy, relative policy, will affect rates as well. Because for investors who are trying to look for yield, you just can't ignore that yield differential.
Bruce, Nikos, would you like to perhaps chip in with a comment?
Okay, I start. I would tend to agree with Johnny. Look, metals focus has a not crazy bearish outlook for the US dollar, but we think the US dollar looks toppy at the moment. It's had a huge benefit as a result of the expectation that you know, it's the other main reserve currencies, shall we say, such as the pound, where there was an expectation. I mean, I am joking, by the way. I was referring to the euro and the yen. I think the dollar has been benefiting by the fact that there was an expectation that interest rates would continue increasing for that, but not for the other main reserve currencies. This is very much changing at the moment. If anything, you could be in a situation in a year's time where you have the direction of travel being the opposite, because there's not that much more that the ECB can do in terms of loosening, whereas, you know, the Fed does have some space to do some. And on the basis of that, and also on the basis of the fact that for quite a number of years you've had a run on emerging markets, you've had US equities outperforming other equity markets. Even when that trend reverses, you naturally will have flows of money away from the dollar and into other currencies. And I can't help but expect that this will put the US currency under pressure.
Bruce?
Yeah, I tend to agree. I mean, as in Johnny's presentation, central banks, you know, are buying gold, especially Russia, China, and other emerging countries. Like, you know, like, not like before. I mean, this 650 tons or something in 2018 was like the biggest purchase that we had seen. And that's really solely because they are switching from US dollar to gold, especially Russia, China. I think that move really kind of, show us how they regard current strengths of U.S. dollar would have some implication of the, going too far, too much, especially, same as the stock market. And I think, like, the money is kind of flowing out of gradually to gold or like to Japanese yen as well. I mean, yen is so strong, 108, 107. From my point of view, inhabitant of Japan, this currency is not really, it's not supposed to be such strong. I mean, if you look at the financial situation of Japanese government. But still, I think some people regarding the Japanese yen is better asset than US dollar at the moment. So I think I really tend to agree that US dollar might have hit the ceilings.
Thanks, Bruce. You mentioned central banks, and I think in a way, you could look at central banks as being a bit of a canary in the gold mine, because we actually haven't. I mean, the 650 tons last year was a great number, but if we actually look at the decade of the 2010s, current decade, we haven't seen central bank purchases on this scale since the 1950s. And let's contrast this also with the previous decade in the 1990s when we had substantial net central bank selling. So this is a really important change, I think. Now the question is that change just driven by certain countries' special situations? Because if we look at, say, central bank purchases, they are concentrated amongst Russia, China, and Turkey, countries which are not great friends of the United States of America. But on the other hand, perhaps they are telling us something, that the current international financial system, which is dollar-based, perhaps cannot deal with the strain of the Trump administration and the US abusing its exorbitant privilege, and that this is probably perhaps not just a Trump thing, but a US thing looking ahead. Ergo, gold comes back into play, and you want to have more gold, and you certainly don't want to sell it if you already have a lot of it. Do you sense that there is a sort of change in the wind here, and that central banks will continue to buy high amounts of gold and maybe even buy more in future if they have a strategic need to move away from the US dollar, not just for portfolio diversification, but for basic strategic political requirements? Perhaps we start with Joni.
I think my compliance clearance doesn't allow me to talk about politics. But what I will say is that...
economics?
Yes. Well, let's bring the conversation back to the point about diversification. And I think the first wave of buying that we saw from the sector came from emerging market central banks that saw growth in their total reserves, and therefore the need to diversify into gold was there. They had little to zero gold allocation, so it made a lot of sense. This time around, actually from last year, you didn't see that same trend. Instead, you just saw central banks going out and adding to their gold reserves. And I think it is a combination of several factors, one of which is being worried about their dollar exposure. As we've all said on the panel, we think that the dollar looks toppy, there is some downside there. And sure enough, I would think that central banks would also be looking at those risks. So the need to diversify would also be there for them from that perspective.
Thank you. I think Nikos isn't perhaps constrained by compliance in quite the same way at Metals Focus. Charles and Philip.
My compliance department is Charles the Measton, and as you know from his dining stories,
yes,
there's not that many restrictions placed on me whatsoever. But I think, look, I take the points made, and it's a fact. We don't even have to speculate that there is an element of politics involved. Certainly, when it comes to Russia, for instance, where there's a difficulty to access dollars or use dollars, and there is a natural tendency to, well, there will be a natural tendency to find other homes for the country's wealth than dollars. I think I think the portfolio diversification argument, though, in the long term, is still the dominant factor here. Take China, for instance, notwithstanding what you're seeing in terms of tariffs and in terms of what the future of the trading relationship between China and the US will be, China is still naturally a net absorber of US dollars, and China is still overweight in US dollars in many ways. So again, I think it would be a miss of any portfolio manager or reserve manager to not try to move this wealth around to other currencies, including gold. Yeah, so I think I agree with you in part, but I would still say that the portfolio diversification argument is, in our humble view, more dominant.
Bruce?
Well, I personally really think its political implication is quite much, because China just, I mean, People Bank of China just announced that $15 tons purchase last month again. I mean, it's quite obvious that they are happy to announce it. That in consecutive months, and they are quite. 15 tons are a very good amount, and that is very clearly happens after this trade wars between U.S. and there's very big pressure on it, and I think it's both. I mean, Russia, China has too much dollar. That's for sure. So asset diversification is one way, and maybe political situation would support that kind of move. And I think this would continue, and that support gold prices for sure.
Right. I hope Albert doesn't mind me using a 4-letter word from this platform. Debt. If we can perhaps look a bit further ahead, pick up again on a theme that the great Bart Melek introduced this morning, which was rising debt, both private and public sector in both developing and developed countries. Is there not going to be pressure for central banks to keep rates at the very lowest level, particularly if there's any economic weakness, in order for governments and others to be able to finance their debts? And could also part of the solution for that be higher rates of inflation? I know central banks have tried to create inflation without much success, but maybe with modern monetary theory and other techniques next time round, they will succeed and have to succeed in trying to raise the rate of inflation in order to bring down the real value of debt obligations. And of course, under those circumstances, you'd imagine gold to have a great run. Maybe start this time with Bruce. Do you think, your country, of course, is pretty high up in the debt stakes. Is there going to be potentially, in spite of Japan's deflationary tendencies, a Weimar solution or mini Weimar, minor Weimar solution to this?
Well, yeah, as you point out, the Japanese government has huge debt, and I think they are happy with it, and and they're trying to lower rates, whatever is possible, and but for us as a Japanese, personally, I'm telling my friends and investors that to protect our own wealth by investing US dollar or gold denominated in yen, because we have, I think yen is too strong with this debt, and so there's a good chance for the yen to be weakened. And in that case, like dollar or yen-denominated gold would be a very good protection for the inflation. As a government level, I think they are not really worried about this. But as other individual investors, I really worried about this. Too much debt. And now, I mean, there's lots of talks about the government can print whatever they want. I mean, the yen. So, but I don't really trust that kind of argument. So I'm worried.
Okay. So Nikos, I mean, given the US government is already issuing $1 trillion of debt a year, I mean, do you think that looking at issues such as aging population, expected, you look at Congressional Budget Office's projections for US budget deficit and debt, it's quite frightening. Is this going to be an issue in future that's going to become more and more important to investors as they see the possibility of some kind of inflation solution to this, or maybe just, the creditworthiness of the US government will be brought into question, and that this is going to lead to people looking for an alternative safe haven?
Perhaps, but probably not before I retire, I would say.
So you're not retiring in the next 10 years?
Probably not, I don't think. No, glib comments aside, I think, so there's two elements to that question. Starting with the inflation question, do I think it's likely that we see high inflation levels? It depends what we mean. Can we see 2-3% inflation levels, which are high compared to what we're used to now? Sure, why not? But can I see a sort of Weimar proper inflation, or what we used to be called?
How about 5 to 7%?
I think that's pretty hard to envisage in the next few years, purely because I come from a very traditional school of thought that thinks that unless you have real serious wage inflation, it's very hard to have proper inflation levels. And even in the jobs miracle of the United States, I think there's still slack. There's still underemployment. There's still people who are not part of the workforce that could enter. And in a globalized world, I think it's very difficult to have seriously strong inflation. I think the numbers prove that, right? The stagnation of salaries in the past decade suggests that. In terms of creditworthiness, I think as long as the US has this advantage of its currency being the base, I think it's very difficult to have a genuine collapse in creditworthiness. Now, could we see rates being, the norm being a bit higher? Yes, and arguably this is why the US borrows at what it does and Germany borrows at minus, right? But I just can't see people viewing the US as they view Argentina, for instance.
Yeah, okay, that's perhaps verbal flourish, but compared to, AAA rated, can we see question marks about?
Can't imagine the US losing its AAA rating anytime before I retire. Yes.
Okay. Jenny?
I guess your question earlier about, or your comment about the central banks trying to sort of keep rates low because of the big debt that the US already has, I would go back to the central bank's independence and their focus on sort of their two sort of mandates, which is growth and inflation. So maybe it will look like that as a result, but I think in terms of the central bank's intentions, they will continue to try to generate inflation perhaps by keeping rates low, and that will just be sort of the impact. But I do get your point that some investors tend to look at this, and these are some of the arguments why they like gold. And I think that you will always have those people. But to me, it goes back to what will drive interest in gold looking ahead into the future would be really sort of if real rates move into negative territory and it becomes an attractive investment.
Right. Okay, I think that's been a very interesting series of comments we've had on the four precious metals. I think before we close this session, just like to ask one question to the audience, which I think you can reply with through the intelligent use of technology. We could also have a show of hands if we prefer to do it old school. And that is, at the APPMC in 2021, will gold be above $1,500? So, have we got the technology working? If not, I think we can just raise hands. It'd be interesting to see what the balance of opinion is. Good. Yes, it was there a moment ago. So the question is, will gold be above $1,500 per troy ounce at APPMC in 2021? Yes or no?
I think hands might be a little bit faster.
Okay, I think you're right. Let's back this up by a trade union style show of hands. Will gold be above $1,500 per troy ounce? I think it will be. And those who think it won't be? Well, it looks like the bulls have it. We're all collectively reasonably bullish, therefore, from today's 1329. Yeah, but you could take an opposite view. Thank you very much for your attention, ladies and gentlemen. Can we have a round of applause for our three panelists?
Thank you. Shall we have a joint photo?